Now let's talk about rollover relief. So first of all, we need to understand that when rollover relief is available, what is the definition? So again, may be rolled over, that is deferred. So it's a choice where it arises on the disposal of a qualifying business asset. It's very important that you have disposed of a qualifying business asset and the proceed of that asset are reinvestment again in another qualifying business asset. So if a person sell an asset, which is a qualifying asset, and get the proceed and invest into another qualifying asset, then there is a possibility, there is an option that gain can be deferred, right? So suppose I have disposed of a qualifying asset and gain is 100,000 and I've invested the whole proceed in another qualifying asset, then what I can do, I can deduct the whole relief here and the gain becomes zero. And now this gain will be deferred. It means that I will pay tax. It's not exempted, but at a future date when that qualifying asset which I have purchased will be sold out. So this is the whole concept behind rollover relief. Now, important question is that what is a qualifying asset? So both the old one and the new one, that is the disposal one and the acquisition one, must fall into one of the following categories. It will be either land and building, or fixed plant and machinery, or goodwill. Remember, both the old and new asset must be used in the business. That is a condition. Otherwise, your rollover relief will be restricted to business percentage. And also remember that the old and new asset must not be the same category, must be qualifying, but not the same. For example, you have disposed of a building and invested in fixed plant and machinery, that is also acceptable. You don't need to put in the same asset, remember. Now, as far as the relief is concerned, the gain is not taxed immediately but is postponed until the trader makes a disposal of the replacement asset without further replacement. The postponement is achieved by deducting the gain made on the old asset from the cost of the new one. So what we have to do, we have to find out the base cost of new asset. So this is the replaced asset cost, and immediately we will deduct the relevant ROR from this, and this becomes the base cost of the new asset. Now, when we sell that new asset, so we have to compare the selling proceed of that new asset with the base cost. And as a result, what would happen? The gain, the previous gain, and the gain on new disposal will be taxed in the year of disposal of the replacement asset. Another question is, sometimes suppose the proceed was 100,000 and reinvestment is not 100,000, it's less than 100,000. So where the disposal proceed are not fully reinvested, the surplus retained reduces the amount of capital gain that can be rolled over, and in that case, partial amount is taxable immediately and partial amount is rolled over. Now, as far as the qualifying time period is concerned, remember, it's very important that you should know what is the condition related to qualifying time, and you have to dispose of and buy those assets within the qualifying time. So the replacement asset must be bought in the period 12 months before to 36 months after the disposal of the old asset. So we have into altogether 48 months. But how that 48 months work, it depends. Suppose the disposal is on 1st May 2022. So after disposal, we have 36 months to buy that asset, and before disposal, we have 12 months. That means if you have disposed of an asset on 1st May 22 and 1 month or 2 months back, 12 months back, you have already purchased an asset, you can connect those assets in together. So important is 36 months after the disposal or 12 months before the disposal, you can connect this acquisition. And also it's very important that once you opt for the rollover relief, a claim must be made within 4 years from the end of the tax year in which the disposal occurred. So for example, if the disposal year is 22-23, we have deadline of 4 years after the end of the tax year. That is, we have from 6th April 22 to 5th April 23. This is the tax year. So we have 4 year, that is 24, 25, 26, 27. So it's 5th April 27. This is the deadline. In the year of disposal, count 4 years. Also, keeping in mind that sometimes the asset that is disposed of or the asset that has been purchased, there is some non-business component. Now, what to do with this non-business use? Full rollover is available only where the asset being replaced was used entirely for business purpose throughout the trader's period of ownership. Where the condition is not satisfied, rollover relief is limited in proportion to the business use. Suppose, for example, the asset that is disposed of was 80% used for business purpose and 20% used for private purpose. So whatever is the ROR, will multiply this with 80%, that is business use. Why? Because rollover relief is only available on business use, not on non-business purpose. Now let's try few example. Suppose Anaya purchased an asset that is qualified for ROR in January 2005 for 1,60,000. This is the original cost, 1,60,000. In August 22, she sold the asset for 1,80,000. That means a gain of 20,000. So asset was sold in 1st August 22 and spent 200,000 in November 22 after a few months. And this new asset cost is 200,000. Now see, the proceed was 180 and the investment was more than 180. So full reinvestment was there. Calculate the chargeable gain arising on the disposal of the asset, assuming that ROR is claimed, and calculate the base cost of the new asset acquired. So first calculation is selling price 180, cost is 160, and we have 20,000 of gain before any relief. Now, as full reinvestment was there, so rollover is 100% and that is 20,000. So there is no gain taxable in the current year. Now, new asset cost. New asset was acquired at a cost of 200,000. Deduct ROR from this 20,000. So I have 1,80,000. This is the base cost that will be used in the subsequent disposal of the new asset. Let's discuss another example. Gina purchased a warehouse in Feb 2011 for 1,70,000. This is the cost of the warehouse, 1,70,000. In July 22, she sold the warehouse for 300,000. This is the disposal proceed. She used the warehouse for the purpose of the trade throughout the period of ownership. In December 2024, Jenna bought a new warehouse for 3,60,000. So new asset is 3,60,000. She plans to sell the warehouse in January 2026 for 5,50,000. Expected sale is 5,50,000 of the new asset. Calculate the chargeable gain arising on the two sales, assuming rollover relief is claimed. So first one, in the year 22-23, sale proceed, that is 300,000. Its original cost, that is 1,70,000, and resulting gain is 1,30,000. Full ROR is available, 1,30,000. So the whole gain is deferred. Whole gain is deferred. And the new asset base cost, we need to identify. Cost of new asset is 3,60,000. Deduct ROR 1,30,000. So now the base cost is 2,30,000. This is the base cost. Now, disposal of that new asset. So as a result, the sale proceed in the year 2026. Cost is now base cost. So 5,50,000 minus 230, it's 3,20,000. And this is the gain, and this is subject to tax. Now, as far as the partial reinvestment is concerned, we have to see whether the proceed is reinvested entirely or not. So the rule is, in case of partial reinvestment, the chargeable amount is lower of gain original and amount not reinvested. Whatever is the lower amount, this lower amount is chargeable immediately. Now suppose, for example, there is a gain of 50,000 on a disposal of asset where the sale proceed was 200,000 and reinvestment was only 1,90,000. Calculate how much is chargeable. Chargeable gain and rollover relief. Now see, first of all, amount not reinvested. Let's find out amount not reinvested is, we received 200,000 from the proceed. We have invested only 190. So this 10,000 is not reinvested. Now, lower of is taxable. So gain 50,000, not reinvest 10,000. So lower of is 10,000, chargeable immediately. Now we have original gain, that is 50,000. ROR is the balancing figure. Right here, chargeable amount, chargeable gain, which is 10,000, and ROR is the balancing figure, that is 40,000. So in the case, we have to keep an eye on this type of issue too, partial reinvestment. Let's see one example. So Sharifa bought a factory in September 20x6 and in December 2022, wishing to move to a more convenient location, she sold the factory for 7,50,000. Now factory has been sold. The cost of the factory was 6,35,000. Sharifa moved into a rented factory until March 2023 when she purchased and moved into a new factory. Calculate the amount of the gain which is chargeable, if any, on the sale of the original factory, and calculate the base cost of the new factory, assuming the new factory was purchased for 700,000 or 5,50,000. Let's deal with the first scenario, that the case is new factory is purchased for 700,000. Let's deal with this scenario. So sale proceed of the first asset 7,50,000. Original cost was 6,35,000. So we have a gain of 115,000. How much ROR is possible? That would be a balancing figure. And this is chargeable gain. Now see, the proceed was 750 and reinvested amount is, first one is 700,000. So 50,000 not reinvest. And this is immediately chargeable, lower of criteria. 50,000 is immediately chargeable. So a difference of 115 minus 50, that is 65,000, is the rollover relief in the first case. And now new asset cost is 700,000. Deduct ROR, that is 65,000. So we have a base cost of 6,35,000. This is the base cost. This is the first scenario. The second scenario, which is where the new asset cost is 5,50,000. Again, sale proceed of the original asset 7,50,000. Original cost was 635,000, and we have a gain before relief is 115,000. This is gain before relief. Look for the ROR possibility and the chargeable gain possibility. Now this is lower off. So A, gain 115,000, B, amount not reinvested. So we get 7,50,000 and reinvest only 5,50,000. So 200,000 is not reinvested. Now 200,000 is not reinvested. So lower off is entire 1,50,000, 15,000 is chargeable. So this is chargeable. So it means in this example, your reinvestment is not that enough. So you don't have any option of transfer, deferred. You can't defer in this scenario. Now let's discuss one example related with business asset and non-business asset. ROR is only available in case of business asset. Robert acquired a freehold commercial building in April 24 for 65,500. This is the cost, 65,500. 60% was business use and 40% was private use. The building was sold at a price of 1,62,000. A replacement building was acquired in January for 1,80,000. New asset 1,80,000 and used 100% for business purpose. The replacement building was sold for 2,50,000. Calculate the gain rolled over and chargeable gain arising on the disposal in November 22 and May 23 on all the assets. So first of all, let's talk about first building working. We have a sale proceed of 1,62,000, deduct cost of 65,500, and we have a gain of 96,500. Gain before relief. Now see, as the whole proceed is reinvested, so full ROR is available. But as the disposal asset is 60% business use, so ROR is available, and that is 96,500 into 60%. So ROR is only available at a rate of 60%. And let's calculate 60%. So 96,500 into 0.6, it's 57,900. So we have 57,900 ROR, and the rest is chargeable. That is 38,600 is chargeable immediately. And as a result, the new asset base cost would be 1,80,000. Deduct ROR, that is 57,900, and resulting base cost is this one. Now, what about the new asset disposal? So sale proceed is 2,50,000, and now base cost is 122,100. So as a result, the gain is 127,900 on disposal of the second asset. Now, another concept is sometimes we sell a qualifying asset and dispose of, after disposal, we reinvest into another qualifying asset, but that qualifying asset is classified as a depreciating asset. Remember, a qualifying asset is land and building, fixed plant and machinery in goodwill, and fixed plant and machinery is a depreciating asset. So what is a depreciating asset? A depreciating asset is a vesting asset with a predictable life of 50 years or less, or an asset that will become a vesting asset within 10 years. So in case of leasehold property, having life 60 or less falls under this definition, will become a vesting asset within 10 years. And fixed plant and machinery having life of 50 or less. These two asset falls in this definition. Now, what would be the outcome of this? If the new asset is a depreciating asset that you have acquired, the gain deferred is not deducted, though gain will be deferred, but not deducted from the cost of the new asset. That is, will not find the base cost of the new asset. The cost of the asset will remain the same. Instead, the gain is deferred and postponed until the earliest of that you need to pay tax at the earliest of these three events. Number one, disposal of the new asset, the date the new asset ceases to be used, 10 years after the new asset was acquired. Remember, acquired, not dispose of. So new asset disposal and 10 years and the cessation. Whichever comes earlier become the taxable one. And it might be available before the disposal of the new asset. And if a new non-depreciating asset is acquired before the disposal, before the deferred gain becomes taxable, then you can claim rollover relief on those assets as well. So the capital gain on the original asset is then rolled over into the new non-depreciating asset, and the depreciating asset is effectively ignored. So what we can do, we can purchase another qualifying asset, a non-depreciating asset, in order to continue our rollover for a period of time. Now let's see one example. So the concept is almost the same, but there is a payment difference, that payment is to be made after a certain period of time. Let's see this example. Lilly purchased a freehold factory in June 94 for 2,50,000. This is the cost, 2,50,000. In May 21, she sold it for 4,20,000. And in June 21, bought a fixed plant and machinery, new asset, a fixed plant, which is a depreciating one, at a cost of 4,50,000. In March, Lilly sold the fixed plant and machinery. So he bought on June 21 and sold this in March 23 at a price of 475,000. Calculate the chargeable gain arising in the tax year 21-22 on the first disposal, and 22-23 assuming Lilly claims ROR wherever possible. Now the first disposal, sale proceed 420, cost is 2,50,000 and a gain of 1,70,000. Now this disposal is in May 21. So the tax year is 21-22 and there is 1,60,000. So the gain is rolled over, that is deferred, the whole one, because the whole proceed is reinvested. Now the new asset cost will remain the same. It's 4,50,000 and it's a depreciating one. Now subsequently that asset has been sold. So gain is 4,75,000. Cost is 4,50,000 and his gain is 25,000. Now the first gain that is deferred is where the new asset has been sold within 10 years, before 10 years. So it's tax due on disposal, that is March 23, with the disposal of the second asset. So as a result, we have two gain taxable. One is the previous one and one is the new one. So the total gain is 1,95,000. Let's discuss another example. Amir purchased a freehold factory in May 1996 and in May 10 he sold it for 3,50,000. So cost, we need to identify cost. Cost is not there. Sale proceeds 3,50,000. Gain is given 1,50,000. In July 2012, Amir bought fixed plant and machinery for 400,000. So fixed plant and machinery 400,000 in July 2012. In March 2024, Amir sold the fixed plant and machinery. Plant and machinery sold for 500,000 in March 24, more than 10 years. Calculate the chargeable gain arising in respect of the sale of the freehold factory. First one, fixed plant and machinery. Second one, assuming Amir claims ROR where possible. Clearly identify in which tax year the gain arises. So the first one, gain is 1,50,000. Entire proceed is reinvested. So full ROR is claimed against this, deferred. The tax year was, disposal was in May 2010. So the tax year was 10 and 11. Now the new asset is purchased in July 2012. 2012. That is in tax year 12 and 13. New asset was purchased. and that asset was sold subsequently at a price of 500,000. Its cost was original 400,000 and a gain of 100,000 is taxable in the year that asset has been disposed of in March 2024. March 2024 means is in 23-24. This is taxable. Now, what about the previous one when it is chargeable? So the previous one was in the year 10 and 11, and the rule is that when you purchased a new asset, when you purchased a new asset here, and the tax is payable earliest of, the gain is freezed until the earliest of. So here the earliest of date is 10 years. Disposal is after 10 years. So July 22 is the trigger point for the tax calculation.